a word about the cash flow statement. At this point in our program, we might find this statement difficult to comprehend. We are not alone. It is a challenge for the ablest of college students. Not to worry. Go through the chapter and just expect to have many questions. When we go through the material on the accounting cycle, the section on accounting theory, and the chapter on depreciation, a lot will be cleared up. Then review the chapter one more time. If it is still unclear, you might consider acquiring our supplemental study guide for this subject, or all of the study guides. If it is still a fog, write to us and we will get back to you. With that said, let us begin. This statement is not always prepared by many companies. For publicly traded companies, it is required. And if we examine the financial statement filing of any publicly traded company, we will see the cash flow statement. What it does is start with the opening cash balance for a company and explains how it got to its closing cash balance. Entrepreneurs who do not prepare this statement or do not understand it are oftentimes asking questions like, my accountant says I made $150,000 and I owe taxes of $40,000, but I only have $30,000 in the bank. How could I have made $150,000 and only have $30,000 in cash? How indeed. The cash flow statement answers that question. At this point, you may be confused with those examples. It's understandable. The cash flow statement is by far the hardest statement to understand. We will attempt to clarify the issues. After we've been through this chapter, if you're still confused, you might consider getting our supplemental study guide for this topic. If things are still not clear, contact us, and I or a member of our staff are here to help. Let us begin. There are three sources or uses of cash in a business. 1, the first is cash flow from operating activities. 2, the second is cash flow from investing activities. 3, and the third is cash flow from financing activities. In these three sections, we identify all the possible conditions that contribute to a change in cash in a business. As we shall see, cash inflow does not necessarily mean revenue, and cash outflow does not necessarily mean expense. First, we have 4 transactions affecting cash. 1, we paid a dividend of $95,000. 2, purchased equipment for $215,000. 3, we borrowed $30,000 on a note. 4, we sold stock for $100,000. Item 1 is a cash outflow or use of cash. Item 2 is a cash outflow or use of cash. Item 3 is a cash inflow or source of cash. Item 4 is a cash inflow or source of cash. Our first category is income from operating activities. Understanding this first category can be challenging, but we will endeavor to make it clear. To make it clear, we will need to review the chapter on accounting theory, also the chapter on the accounting cycle. Beyond that, we have the supplemental study guide. Still not clear? Contact us. We are here to help. Our first category of data is the earnings statement, showing net profit of $185,000 and $65,000 in depreciation. We start with the earnings statement showing earnings of $185,000. From these earnings, we make some adjustments. The first adjustment is adding back the $65,000 in depreciation. Depreciation was a deduction arriving at net income, as we can see from the earnings statement. However, depreciation is a non-cash expense. It is an allocation of part of a fixed asset's value to expense ratably over time. Since this expense does not involve any cash, we add it to net earnings as part of cash flow from operations. Here we have comparative balances and the net change from 2022 and the latest year, 2023. Cash balance has gone down from $210,000 to $190,000, a decrease of $20,000 year over year. Now let us look at the changes in current assets. Accounts receivable have gone up year over year by $40,000, from $250,000 in year 2022 to $290,000 in 2023. We show the change, an increase in accounts receivable of $40,000 as a net decrease in cash, because an increase in accounts receivable means we did not collect on $40,000 worth of accounts receivable that we billed. Inventory went from $325,000 to $360,000 in year 2023. It takes cash to buy inventory, and our inventory went up by $35,000, lowering cash by a like amount. Prepaid expenses went up year over year by $15,000. Balance in year 2022 was $40,000, and the balance in year 2023 is $55,000. In the next line item, property, plant, and equipment went up to $1,150,000 from $1 million in the prior period, an increase of $150,000 and a use of cash of $215,000. Why $215,000? Our equipment account went up by $150,000, but went down by $65,000, the depreciation expense. Allow yourself to be confused at this point. Actually, in a previous slide, we said equipment purchases went up by $215,000. So why is the year-over-year change only $150,000? That is because we took depreciation of $65,000. Please allow yourself to be confused by that statement. We will clarify it in due time in this chapter. The final line item in the asset section of the balance sheet is intangible assets, which remain unchanged. In this slide, we see the comparative balances of the liability and equity portion of the balance sheets for 2022 and 2023. Here, accounts payable have gone down by $20,000, from $210,000 to $190,000. It is shown as a use of cash, or cash outflow. It takes cash to lower accounts payable. Accrued expenses have gone up from $30,000 to $45,000, a $15,000 source of cash. Why a source of cash? If accrued expenses go up, it means there is more of that liability to pay. We did not pay all the accrued expenses we incurred. Remember, accrued expenses are a liability. We will clarify that in the accounting theory part of the course. Unearned revenue, not revenue but a liability, because went down from $55,000 to $50,000. When current liabilities go down, it took cash to make them go down. Accordingly, it is a use of cash. Taxes payable went up from $20,000 to $30,000. That means we paid $10,000 less in taxes than what we incurred in taxes. Accordingly, that is a source of cash. In total, we have no net change in current liabilities. Once again, as in past slides of this difficult to understand section, do not be concerned if the concepts and transactions in this section of cash flow statements are confusing. It will clear up, and if it does not, we are here to help. Next is taxes payable, a current liability that went up period over period. If we owe more in taxes, it means that we did not pay as much in taxes as we incurred. So that is a source of cash. All of the above working capital changes are part of cash flow from operations. Mortgage payable went from $670,000 to $700,000. That is a source of cash from financing activities because mortgage debt supports cash flow. Moving on to the equity or capital section of the balance sheet, we see that common stock increased by $100,000 from $800,000 to $900,000. That is a financing source of cash. Next is dividends, which is a payment to shareholders, a financing use of cash, $95,000. In reviewing cash flow from operating activities, we first have net income from the statement of earnings at $185,000. We add depreciation expense of $65,000 to cash flow from operating activities. Subtract $40,000 from cash flow from operating activities for the increase in accounts receivable. Subtract $35,000 from cash flow from operating activities for inventory change. Subtract $15,000 from cash flow from operations for the increase in prepaid expenses. From the comparative balance sheet in the liabilities section, we see that accounts payable has not changed. The total net sources of cash from operating activities is $160,000. To recap cash flow from operating activities, we have net income of $185,000. Add depreciation of $65,000. Deduct $40,000 for the increase in accounts receivable. Deduct $35,000 for the increase in inventory. Deduct $15,000 for the increase in prepaid expenses, equals $160,000. The second cash flow category is cash flow from investing activities. Here we record the purchase or sale of long-term assets. Purchases represent a use of cash, and sale of long-term assets represents a source of cash. Here we see four cash flow events. Paid a dividend of $95,000, purchased equipment, $215,000, borrowed $30,000, sold stock for $100,000. In this slide, we see comparative balance sheets. They show working capital assets increased by $90,000. Equipment, use of cash, $150,000. For a subtotal use of funds, A, $240,000. Working capital liabilities, no net change. Long-term debt, a source of $30,000. Equity up with stock sale of $100,000. And equity down by dividends of $95,000. Up by net income of $185,000 equals net of B, $220,000. $30,000 plus $100,000 minus $95,000 plus $185,000 equals B, $220,000. $240,000 uses of cash less $220,000 sources of cash equals cash down by $20,000. If you are lost at this point, let it go. It will make more sense in time.
Welcome to the new era of video creation with HeyGen. Simply type your script to get started.
The only item in the category of investing activities is a $215,000 acquisition of property, plant, and equipment. The amount is a use of cash, meaning it lowered cash flow. Why $215,000? Change in equipment was $150,000. Equipment actually went up by $215,000, but depreciation of $65,000 brought the net change down to $150,000. Once again, don't fret if this section seems like a fog. The third and final category is cash flow from financing activity. We borrowed $30,000, a source of cash, paid a dividend of $95,000, a use of cash, sold stock for $100,000, a source of cash. Cash up, $30,000. Cash down, $95,000. Cash up, $100,000. For net cash flow from financing activities equals $35,000. Now let us recap the three categories of cash flow. We had $160,000 in cash inflow from operating activities. We had $215,000 in cash outflow from investing activities. And we had net cash inflow of $35,000 from financing activities, for a net decrease in cash of $20,000. Notice in the slide that cash went from $210,000 to $190,000 year over year. Consider what all this means. Our company had a profit of $185,000, depreciation of $65,000, yet cash went down from $210,000 to $190,000. And the cash flow statement, in its three categories, identifies those changes in cash. Here we see all the cash changes and net decrease in cash, even though the company earned $185,000. Its cash balance went down from $210,000 to $190,000. Here we have the formal statement of sources and uses of cash, with $160,000 from operating activities, $215,000 use of cash flow from investing activities, and $35,000 inflow from financing activities, and cash balances going down from $210,000 to $190,000.